to what extent the auditor liable for the opinion that he issues. So the auditor's legal liability is categorized into three. So if you want to understand this simply, so it is divided into three ways. So the first one is under civil liability, and then the other one is under common law. So the auditor's liability can be categorized into either one. So the model looks like this. So on one side, you have the criminal liability of an auditor. And when you're talking about the criminal liability, this is in the event that he goes against the statute or an act of parliament. And then on this other side, we have the liability under statute. So also the civil liability, under common law. So you can say under common law, which is the liability to third parties. Liability to third parties. And also you can have another one. So this both of these are under statute. Also you have civil liability under common under law of contracts. Civil liability under law of contracts. So the main aspect of this liability, they all seem to be the same, because what that means is that the auditor has to be proven for certain extent that he can be held liable. So if you're trying to explain criminal liability, there are certain acts that the auditor will do that constitutes of this criminal liability. Civil liability under law of contract is you're explaining the relationship between the client and the auditor, that there exists a contract between these two that makes him to be liable. Now, civil liability under common law, which is liability to third parties, this is under law of tort. So it is said that an auditor or everyone owes their neighbor a duty of care. So saying that we can hold the auditor liable, we have to know who can sue an auditor. So who do you think are some of the parties that can sue an auditor? One will be, what are some of these parties? One will be which one that can sue an auditor? One is, yes, the client company. The client company, because for example, this contract states that it is between the auditor and the client. So one is client company. Another one is also the investors or the members, investors or members as third parties. As third parties. Also, we have institutions such as government agencies that can sue an auditor. Government agencies such as KRA, for example, KRA, because some of these auditors offer the tax services, so they will have an inclination to some, and then also the CMA, and then also the government itself, the government, for example, in the case of criminal liability. Also, we have another category of creditors. Creditors can also sue an auditor because they will rely on the report of the auditor to give goods on credit. Now, with that being said, then, what constitutes of criminal liability of an auditor? So if you want to understand these three, they bear the same kind of context in terms of liability. So for example, for criminal liability, this is when it arises when an auditor breaches an act of parliament established by a statute. This is just a summarized way of understanding these three forms of liability established by a statute. So if an auditor acts in a manner that shows he has breached this act of parliament, that gives rise to criminal liability. So these instances that may give rise to criminal liability include, so the instances that may make criminal liability to arise is, for example, if the auditor helps the management in concealing a fraud. For example, if evasion of taxes, evading taxes. Secondly, just think about the auditor breaching an act of parliament. Also, we have another one in which the auditor publishes a statement that is misleading, knowing very well that it is misleading. Knowing very well that it is misleading. So what this means is that, for example, if he uses or includes his name in a prospectus that is misleading, and he knows very well that that prospectus is misleading, also in the event that the auditor allows his name to be included, or his name to be included in financial statements that he never audited. So this will give rise to criminal liability, because these users of financial statements, for example, investors, will rely on such a report. And then also the instances where the auditor may act in a manner that is prejudicial to public interest also. So also where an auditor willfully destroys the records of a client also. And then in the event that this auditor still holds office, even if he is disqualified by the Companies Act, where the auditor still holds office, even if he is disqualified by the Companies Act. So we discussed this, Companies Act. We discussed this in our last class, and we said there are some reasons why an auditor may be disqualified from being a company auditor. And one of them is which one? What are some of these reasons? One is one is in the event that he's in business also with an officer of the company, also in the case that he's involved in criminal activities, and in the event that he becomes a servant or an officer of the client and is in partnership with such an individual. So if you go back to where we wrote about ineligibility of one person being a company, also if the auditor is guilty of insider trading. And what is insider trading? So insider trading is said to be where you have advantage or where you have information that is not for the public and you use it to your own advantage. So also this is another one. And then also where the auditor suspects, the entity has engaged in matters prejudicial to public interest. And then but does not report it, but does not report, but does not report to the relevant authorities. So this is the first one. So we also look at the second one, which you're saying as civil liability under law of contract, and then the civil liability under common law or under liability to third parties. So you can look at a question in November 2016, question number 5. You look at that in your past papers, November 2016, question number 5. So November 2016. Question number 5, the whole of it, question number 5. So you're being told November 2016, question number 5. So you're being told you're the partner responsible for providing direction to more junior members of the audit department of your firm on technical matters. Several recent recruits have asked for guidance in the area of auditors' liability. They are keen to understand how an audit firm can reduce its exposure to claims of negligence. They have also heard that in some countries it is possible to restrict liability by making a liability limitation agreement with an audit client. Then you're told required, discuss the civil liabilities of an auditor under common law. So that now is this concept that you're saying here, civil liability under common law. And what was needed in this case of the civil liability under common law. So this relates to liability to third parties. Liability to third parties or under law of tort. Liability under law of tort. Under of tort or under tort. So to explain what a tort is, this is a civil wrong committed against an individual. And what happens for infringement of public liberties? For example, negligence or defamation. So those are some of the examples of torts that are there. Now, for an auditor, it is mostly focused on negligence because you're saying the whole idea is that an auditor, when an auditor enters into a contract, he enters into a contract with the client. So this is the clear relationship that exists. So the auditor is said to owe no duty to the third party because there is no form of contract between the auditor and the third party. But under the law of tort, it is said that everyone owes a duty of care to, or owes their neighbor a duty of care. And everyone is any person that can, or a neighbor is any person who can be affected by an omission or commission of an act. And this third party can be affected by that. So when you're describing this civil liability under law of tort, you first of all state that there is no form of relationship between the auditor and the third party. There is no direct form of relationship between the auditor and the third party. So what there exists is the relationship between the client and the auditor. But under the law of tort, it is stated that everyone owes their neighbor a duty of care. And then you say who the neighbor is, and in this case, this is any person who can be affected by your acts or omission of your acts. And for the third party to successfully sue the auditor, he must prove that the auditor knew that the third party would rely on his report. So this is how you will have structured such an answer in this event. So the thing here to know is that a third party is any person who can rely on these audited financial statements to make an economic decision. So in this case, you're saying an auditor has no direct relationship to a third party. And in this case, a third party means anyone who, a third party, in this case, anyone is anyone who may use the financial statements to make an informed decision. Now, in this case, so the auditor owes, or the auditor owes no duty of care, or the auditor owes a duty of care to the third party under law of tort. And in this case, the law of tort states that everyone owes a duty of care, to their neighbor. And their neighbor means anyone who can be affected. This is anyone who can be affected by commission or omission of an act. So, and then eventually it means then that a third party can sue an audit, a third party can sue the auditor, but must prove certain conditions. And what these conditions are is that, one, the auditor knew that his report will be relied upon by the third party. So one is that the auditor knew his report will be relied upon by the third party. Secondly, that this auditor also breached the duty of care. Also, the auditor breached the duty of care. So that means that due to this breach of duty of care, so thirdly, the third party must prove that he suffered a loss also. So the third party must prove that third party suffered a loss. And another thing is that the loss suffered must be because of the breach of duty by the auditor also. Another reason that must be proven is that the loss suffered was a consequence of the breach of duty. And then lastly, another thing that the third party must prove is that this loss suffered can be quantified in terms of monetary terms. Also, the loss suffered can be quantified in monetary terms. The reason why it has to be quantified in monetary terms is because in law, one of the remedies that is there is called damages. And damages is basically monetary.